Welcome on back to another Meet Kevin report. Today is the critical jobs report following yesterday's ADP report. Boy, this jobs report is going to be even more important. It's kind of honestly a little bit, well, dare I say, perverted that pretty much I feel like people are hoping this is going to be a bad jobs report so that the Fed stops raising rates. I don't know that I agree with that. I kind of hope the economy keeps firing on all cylinders. I kind of want a strong jobs report because do I really care if we have a strong jobs report and the Fed hikes another 25 or 50 BP? No, I don't. What do I really care about? What I really care about is some form of reanimation of core inflation like the United Kingdom had. That would make me nervous. Reanimating inflation would be bad. That is what I really care about. But do I really care about a strong jobs report? Yes, in that I want it to be strong. So this again, this weird idea that people want this report to be weak, and it just blows my mind. It's just it's so backwards. I guess we'll just put it that way. But then again, people want their stocks to go up, so I get it. So anyway, what happened yesterday? Well, we know that yesterday we basically doubled the ADP private payrolls report. Usually we get that 2 days before the jobs report, which comes out in about 7 minutes here. But we got it 1 day prior because of the 4th of July. We were looking at 225 on a surveyed estimate. We got 497, which is actually more than doubled. Today, the Wall Street consensus is looking for a 230,000 non-farm payrolls report. We'll be going through this. We'll look at the establishment survey, the payroll survey. We'll look at the unemployment rate, which we expect to actually tick down from 3.7 to 3.6. We are looking for average hourly earnings to stay stable at 0.3. Average hourly earnings year over year to drop from 4.3 to 4.2, and the labor force participation rate to stay stable at 62.6%. So those are the numbers that we're going to go into the day with. This will be obviously quite a big deal for the markets today, as yesterday when we started pricing in some of this idea that, all right, maybe one rate hike isn't going to cut it. We're going to need two. We did end up getting a little bit of red in markets. This is in contrast to what we've seen since March, where we've really priced in 1+ more rates, maybe 1 to 2 more rates, because we were sitting around 4.9. So we priced in about 1.5 more rate hikes. Markets actually went up. So we'll see. Right now, Fed term rate is expected to be 5.416, which just put us at slightly more likely to get 2 rate hikes rather than just 1. Next Fed meeting is in 2 weeks from now and 5 days. Right now, we sit at 91.8% of a chance that we are going to get a 25 BP hike, with a 27% chance that we're going to get another 25 in September. So with that said, we've got 10-year Treasury yields that made a lot of headlines yesterday. 10-year yields were back above 4% yesterday. This morning, they are up again. We're sitting at 4.076, up another 3.5 bips. This is a pretty wild time. Looking at the 5-year break-even inflation rate. 5-year break-even, we are looking at 2.23, slowly ticking up. This tick up is not great. The plot thickens. We want to see that 5-year break-even rate trend down, not up. And it's starting to trend up again. Not fantastic. So we'd like to see a trend down here, and hopefully we get a stable jobs report here. But either way, the big report we'll really want to pay attention to, that'll come up next, is the CPI report, which actually comes out in 5 days. It's kind of wild to think that in just 5 days, we're already going to be looking at a CPI report again. So CPI comes out Wednesday the 12th at 5:30 a.m., just like this report, 5:30 a.m. I'll be covering it live. The economic calendar does already have some projections for us for CPI on the 12th. So buckle up. We're looking for CPI next Wednesday to come in at 0.3 versus 0.1 prior. Core CPI month over month, 0.3 versus 0.4 prior. CPI year over year for the biggest drop down to 3.1 versus 4%. And CPI core to drop slowly to 5% instead of 5.3 would be very nice. Very nice to get a 4.9 here and potentially even a reiteration that core inflation isn't taking off like it is in the United Kingdom. That would, again, be very bad. So we are now just 4 minutes away from this report. We, again, have yields positive today with the stock market slightly down, 8 bips on the Dow, 11 on the S&P, and NASDAQ down 18. So jobs report will be our beautiful catalyst. Let's see what happens. Zero Phases here says, Peter Schiff says we're going into a depression bigger than the Great Depression when deflation hits. Well, the beauty is we have this history of, and I know this isn't what an Austrian economist wants to hear, but we have this beauty of being able to print money and create inflation when we need to. We have tested that theory, and let me tell you this: it works. We can officially print money and print our way out of deflation. Isn't that great? All right. So other expectations that we have here. It looks like we've got for a 230 Wall Street estimate. This is pretty distributed in terms of what we might end up getting, but the distribution pretty wild again here. Morgan Stanley's at 270, Wells Fargo 260, Societe Generale 250, Goldman 250, 235 HSBC, 225 Barclays, Deutsche Bank, JP Morgan 200, Credit Suisse 190, UBS 175, Citigroup 170. All right. Oh, that's going to be really entertaining. So we'll see what we get. We also have, let's see here. We have, a reminder for you that we have shadowing back, by the way. When I explore real estate, you can follow us around, learn about what we're looking for in real estate and how we operate in person with the agents we're working with and everything. Check that out via the links down below. We are also doing a different style. 1 minute, by the way, to payrolls data. We're also doing a different style of real estate video now. Instead of doing the sort of older school house hack vlogs that we did where they were a little more vloggy, we're killing that idea. And we're just going to go with a topic-based style video. So basically, I'll go through a house and I'll talk about it. And there'll be some of that Noob vs. Pro inspiration from back in 2017 and 18, if you remember those good old days. So here we go. All right. Why all of a sudden am I getting all these texts before jobs data? Don't people know we're focused here? There we go. All right. Here we go. Somebody says I need to fix my collar. It's beautiful. Everything's fine. No, you're right. It's not fine. All right. Thank you very much. Appreciate that. All right. You ready? Here we go. And let's see here. Okay. Here we go. All right. Jobs data is coming out right now. We are waiting for jobs data, expecting 230, and we got 209. It comes in soft. Oh, wow. Okay, well, the market's going to like that. I was hoping it'd be stronger, but okay. Change in private payrolls comes in at 149 instead of 200,000. That's also soft. The average hourly earnings, oh, no, that's not good. Comes in at 0.4 versus 0.3. That's not great. Average hourly earnings year over year comes in at 4.4 versus 4.2. The labor force participation rate is 62.6. The unemployment rate stays, or actually does come in at 3.6 as expected. I don't love that. See, that's actually the opposite of what I would have preferred to have seen. I would have preferred a stronger jobs report with lower average hourly earnings gains. But no, we actually got a tick up in average hourly earnings and a weaker report. So, the stock market's actually going up on this, which is just like stupid. But okay. Then we actually got a downward revision last time. Oh, interesting. And we got a downward negative revision here on wage gains for last time. So not great. We got a 0.3 was the prior average hourly earnings wage growth level that we had. That went to 0.4. Okay, well, at least we didn't go up. We basically are stable at 0.4, which roughly aligns with what you see in the ADP report. But this is a lot weaker than the ADP report. For the prior payrolls report of 339, that got adjusted down to 306. So got a downward revision here as well. And then you got the average hourly earnings year over year that got revised up to 4.4 versus the 4.3 that we had. So in English, what just happened here? Well, you actually got you got a weaker jobs report. The private ADP report came in strong, but they measure things differently than the official Bureau of Labor Statistics. Generally, the BLS report is the one that everybody really cares about and the Fed really cares about, though the ADP report can be a little bit of a fact check tool for us. What I really like looking at in the ADP report is the hourly earnings. We like to see, hey, what's going on with average hourly earnings? And yesterday's ADP report was actually pretty great. Job stayers had pay gains of about 6.4%. Job changers at about 11.2%. These are year-over-year numbers, but those numbers were all falling, right? Consistently falling. We did get the unfortunate news that in this BLS report, you are stable at about 0.4 on wage gains. We'd like to see that come down. 0.4 is unfortunately consistent with 4.8% inflation on a yearly basis. That is not great because 4.8% on a yearly basis is well above the 3% target that the Fed has for wage growth. Note, that is not 2%. Didn't misspeak. It is 3% is the Fed's wage growth target. But we're sitting at about 4.8 right now. So it is less than what it has been in the past, but it's just not. We'd prefer 3, right, or 3.6. Anyway, so non-farm payroll increased 209,000. A lot of estimates here coming out that you're going to see negative payroll prints soon, and that is recessionary. Negative numbers are recessionary, so you want this to be positive. All right. This news release presents statistics from 2 monthly surveys, the household survey and the labor force participation survey via the establishment survey. Household survey data. All right, let's see. 6 million unchanged here, 3.6%. Unemployment rate has ranged 3.4 to 3.7% since March of 2022. White unemployment declined to 3.1%. Adult men 3.4, women 3.1, teenagers 11, black 6%. Asian 3.2, Hispanic 4.3, little changed. Long-term unemployed, little changed. Labor force participation 62.6, fourth consecutive month in a row. Part-time employment for economic reasons increased by 452, reflecting an increase in the number of persons. Oh, look at this. Whose hours were cut due to slack or business conditions. So you're getting more people working part-time right now because their hours are getting cut. Now, this is a new line right here. I don't believe we've seen this in the prior labor reports. For economic reasons, individuals who would have preferred full-time employment but were working part-time because their hours had been reduced or were unable to find full-time jobs. Folks, keep in mind, this is the first miss that we've gotten since April of 2022. First miss since April 2022. That's, what is that, 13, 14, 15 months? All right, let's keep going here. All right. The number of persons not in the labor force who currently want a job was 5.4 million in June, little changed from the prior month. These individuals were not counted as employed, or unemployed rather, because they're not actively looking for a job. Fine. Get off the chair and go look for a job. Well, that'd be Ben Mala for you. Anyway, among those not in the labor force who wanted a job, the number of persons marginally attached to the labor force was little changed at Let's see here. That's fine. 1.4 million. These individuals wanted and were available for work. Fine. The establishment survey was the 209,000. Okay, let's see here. Non-farm employment was an average of 278 per month over the first 6 months of 2023, lower than the 399 average per month of 2022. Now, that's important. So last year, we're trending at basically 400,000 jobs. This year, we're trending at 278,000 jobs. However, now we're down to 209. So Wall Street here is saying this is not the best picture for the Fed. Unemployment rate falling with participation rate holding steady and wages up a bit, signaling somewhat that you still need tightening, but this is some of the commentary here, but you've got that average average wage gain at 0.4%, which again is like, hey, it's still not fully biting the Fed's work here. Average work week lengthened a bit to 34.4 hours. It's interesting. To some extent, what you're finding is if hours are going up, but more people are working part-time, are you putting more work on the people that you're kind of keeping around, right? That is interesting. So, okay, let's see here. First, yeah, okay, we got that. That's okay. I'm just looking at commentary here as well. Keep in mind that after the blowout surge in private sector payrolls suggested by the ADP report, this payrolls figure is quite a lot softer than the market would have expected. Yeah, no kidding. It's so bizarre that the stock market's actually going up on this. Whatever. Anyway, employment in the government increased by 60,000 in June. Fine. Healthcare added 41,000. We've got social assistance adding 24,000. Construction 23,000. You've got 15K on average in construction. You're up above that at 23,000. In June, employment in residential trade contractors continued up. So construction continues to go. Home builders are really pushing numbers right now. It's pretty remarkable. Let's see what Nick T is saying as well. While I pull up what Nick T is saying, I have a feeling what he's going to say is that you should check out the coupon on Building Your Wealth link down below. And the fact that you can now shadow us again when we go hunt for real estate, link down below. If we travel, you travel with us. If we're local, you're local with us. So check that out. Okay, so Nick T quickly, just to see his commentary. The U.S. economy added 209,000 jobs in June. A revision subtracted 110,000. The unemployment rate ticked down to 3.6 from 3.7. This gives you here some of his charts. Private sector payroll growth, 3-month average. Here's your 3-month average plummeting, which isn't great because remember, labor is a lagging indicator. So these, when this starts going down, you really start knocking on the door of recessionary concerns. Not fantastic. I don't love it when that number goes down. So I actually would have preferred a stronger report here, but well, can't always get what you want, man. Employment and leisure hospitality was little changed according to this employment report. That I just also find somewhat hard to believe, but okay. This marks the third consecutive month of little employment change for leisure and hospitality. In other words, people who are going to be employed by leisure and hospitality are already employed, which is very different from that ADP survey. But okay, shows you the volatility of the data. Employment in professional and business services, little change, 21K. Retail trade, negative 11K over here at retail trade. Employment continued to decline at building material and garden center and supply dealers, as well as in furniture. Motor vehicle parts added 6K jobs. Transportation down 7K, little changed. Little change in oil, gas, manufacturing, IT, finance activities, quarrying, and others. Here's your average hourly earnings, 33.58. That is a bump again of 0.4%. On a month-over-month basis, you've got the prior revision, which we've already reviewed. Now let's go ahead and get the actual households data as well. So they always make this a little funny to get, but we can get this household data. There we go. Labor force change from May to June. 133,000, if I'm reading this right. Hold on, let me put this in. I always have just in full transparency, there's so many charts they give you here. I always have trouble reading this. So I'm going to just take a breath here, and we're going to look at this one slowly together. But it's important because remember, you have two surveys. You have the establishment survey, which is your, hey, employers, how many employees you got? And then they count how many people they have on payroll. And then you have the household survey, which is like, the BLS calling households saying, yo, you got a job? And they're like, yo, yeah, I got a job. Well, the problem with that difference is the payrolls one could count that same person multiple times. So it tends to be a little higher. Right here in the household survey. Oh, yeah, what do we have here? Well, okay. Yeah, see, I always have to be careful with this. The civilian labor force increased to 133,000, but the employed portion of that labor force increased 273,000. So you did have gains in both of them, both above 200,000, but the payrolls was actually 209, which is interesting because usually payroll's higher. So payrolls was 209, households was 273. Well, I guess it just depends on who you're calling. And that's why this is why you generally like to use averages when you're looking at these particular charts, which you could jump on over, as we've seen, to the Wall Street Journal via Nick T, or they also give us tables here. But this gives you an example on screen now, what it looks like when you get a little bit more of a charted trend. And then, of course, you can churn this out as a 3-month average as well, which just helps us get a little bit of a better understanding since the numbers are a bit volatile. So if I go for, let's see here, and I want to grab a little bit more information here. Okay, there we go. Okay, so looking at the rest of this report, job leavers. See, this is actually a good thing right here. You generally don't want to see job leavers jumping much. 29,000 is acceptable. So that's great because job leavers implies that people are voluntarily leaving and they're leaving because they think they can get a better job. But if you're part-time for economic reasons, increasing 452,000, that's quite a big bump. Could only find part-time work, 124. Slack or slow business work, 308,000. These numbers trending up. Let's see how we've been. June 2022, and we have April, May, June. Okay, so last year is here, and then April, May, June. So you can see some volatility in the numbers over here. Kind of looks like we've gone down to up for these numbers here. Compared to last year, we're definitely above these, though. So only able to find part-time work because of slow business, that's starting to really increase right here. I'd be paying attention to this quite a bit. That's a good one to pay attention to. Okay, let's see what else the suits are saying. And then we'll take a look at markets reaction as well as rates. So some commentary here that this report probably won't mean much for the Fed, that it would really take an employment report below 100,000 to get the Fed to consider actually pausing. But what it probably is going to do is it's probably going to start reducing the odds of a second hike. This might kill the second hike odds. We're probably still going to get that July one, even though I disagree with that idea of this sort of pause start nonsense. It's probably what's going to happen. Let's see here. Okay, we saw that participation rate was unchanged. Pickup in manufacturing employment. Really? I didn't see that. Maybe because of all the spending on EVs and battery plants is the suggestion here. I'm not convinced by that. Let me see here. Manufacturing, I thought was stable. Manufacturing. Yeah, I don't know where they're reading that. It says here, little changed for manufacturing. So I don't know why. I mean, it must have been a small pickup if they're noticing a pickup somewhere. Okay, and again, remember, this is a lagging indicator. You also have service. Oh, that's interesting. Temporary help service payroll. So temporary help with your business actually ticked down again. Also another leading indicator. Okay, let's see. Okay, let's look at treasury yields just to get a little bit more market reaction. Note that a bounce back in the household survey gauge rose by 273,000 in June. In May, there was a 310,000 job plunge. That was a big contradiction. It's so volatile on a month-over-month basis, the data. Okay, so now all of a sudden the market is green, though. You're up 39 bips on the NASDAQ, 12 bips on the S&P. Dow's up 4. Enphase up 0.07. Tesla's up, 0.28 over here. Interesting. And then what we have is we look at bonds. We're actually still seeing the 10-year with strength at up 1.9 basis points, sitting at 4.06. If we look at the 5-year break even, it's ticked down a teeny little bit to 2.22. The terminal rate is still sitting at 5.41, so still a little bit of pricing in the second rate hike. Anything above 5.375 would be pricing in a little bit. Then you've got 91.8 is still your expectation, 91.8% for the next hike. And still sitting at 27% for September, excuse me. So, okay, that is pretty good. Let me quickly see what other kind of commentary it looks like we're getting. Let's see here. No other really good commentary other than this was the lowest and first miss on a jobs report since April of last year. Pretty remarkable. And again, market positive about this. Let me just reiterate why I'm not so positive about this. The concern, obviously, is if wages are going up by the tune of about 0.4%, that's your overall wage set. And you continue with strong, let's assume we continue with strong hiring in leisure hosp. You're probably going to be in a place where spending in leisure and hospitality is going to blow up. And so there is this risk over the next 3 months. And it's a short-term risk. It's not going to be a long-term risk, I don't believe. But I think there's a 3-month risk that you end up with elevated wage gains, low employment reports, sticky or even slightly rising core thanks to travel inflation, right? And then a Fed that somewhat starts getting nervous that core inflation is rising and low employment sticks around, which is somewhat, I hate to say it, stagflationary. This is what you don't want. I do think you have this short-term 3-month risk thanks to really summer travel here and summer spending. So I do think that creates some potential short-term headwinds for stocks, even if it's just the fear that this could happen. It's not good because it's going to lead the Fed to talk even dirtier to us. It's not just a matter of the hike of 1 or 2 hikes. It's the dirty talk. Anyway. That adds us or throws us together with or gives us a full look at the employment report and jobs data. All right. Let's move on to, let's take a quick listen over here to what they're saying. And then we're going to jump into some other reports in a moment.
The reason they've been talking about the labor market being tight is because it feeds into wages, which they believe feeds into the service sector inflation in particular. So I think you're right to point everyone to that number, and that number, again, slightly higher. So I think this certainly says that the market expectation of a 25 basis point move at the next meeting, I think, has been reinforced here. And I actually put slightly higher odds than I think the market is today on another 25 basis point tightening before we get out of this year.
Roger, the bull case, if you're looking at equities, is that, okay, even if you're talking about another 50 basis points, 2 more hikes from the Fed, you're still getting to the end of rate hikes, and that could be potential good news. Is there any reason you see to argue with that?
I think certainly it could be potential good news. If I were looking at the equity markets, the real question would be picking and choosing. There are some sectors that I think are going to slow more than others as interest rates continue to rise and importantly stay higher than maybe the markets currently expect. So I can understand the bull case saying the Fed's almost done, but recognize still how much has already been done in terms of interest rate hikes and where we're seeing some slowing versus some forward momentum. The market, as you know, has been very focused on the very good news in the tech sector and perhaps downplaying some of the weakness in some of the other sectors.
All right, let's play out what you think odds are for a recession at this point, because for a while you had been more concerned that a recession was more likely than had been before. Do you still think that's the case? And is there the potential for a soft landing when you continue to see how strong the consumer's been and how strong the job market's been?
Well, certainly we should welcome the strength in the consumer spending and job market and job creation. Those I do think increase the odds of a soft landing. What I've said, and I still believe it, is a recession, if there is going to be, short and shallow. And at the end of the day, the distinction that we're going to draw between a short and shallow recession and maybe some sort of softest landing is going to be marginal. So I think overall, my view hasn't really changed. Whether or not it's called a recession, others will decide that. But I think we'll have some more slowing left because, as the Fed said, and others know, the amount of tightening that's in the system, still more to come. And I think that does portend for some sort of softish behavior here, right on the edge of a recession, maybe a soft, shallow, short, shallow one, maybe a soft landing. What's
the most important number you look for next?
I think I still continue to look at three things: the JOLTS numbers, just to see if we're still in that 1.6, 1.5 openings per unemployed individual. Obviously, continuing to keep an eye on wage pressures, very, very important. So I think it's all about the labor market right now, Becky.
Okay. Roger, thank you. Great to see you.
All right, let's go jump on into some of these other reports that we got to cover and get to today. So let's see here. We are going to look at, where is my beautiful report? I will have it in just a moment. But what we're going to go through next is a Bank of America report on 6 scenarios that the economy may actually end up going through. And it's, quite interesting to see what the 6 scenarios are there, and then which Bank of America somewhat leans towards. So we'll be going through some of these. And yeah, let's see what we got. All right. So 6 scenarios. It is 33 minutes into the Meet Kevin report. All right. Here we go. Well, Bank of America just released their 6 scenarios for what's going to happen with this economy. And unfortunately, Bank of America starts with, we remain concerned that markets are too optimistic on what it will take to bring inflation down. Not great. In this video, we are going to discuss the 6 different scenarios Bank of America believes could play out when it comes to recession or not. So the first scenario is the no landing scenario. They believe this is likely to be unsustainable. They indicate that headline inflation has come down, and while the economy has been resilient and the labor market has been stretched, which would be even better than the consensus estimate that basically the economy just keeps going, that we just don't land the plane, so to speak. It's just the economy just keeps going. Everybody continues spending money and everything's fine. And it's even more optimistic than the soft landing, is what Bank of America argues here. And it's consistent with the argument that inflation was transitory after falling on its own. And unfortunately, as much as this would be fantastic, that the economy keeps going, inflation goes away, and we don't go into a recession, Bank of America believes that this is not sustainable. They essentially argue that the easy part of disinflation is over. And instead, now we have to deal with that sticky core inflation. That's going to keep pressure on from the Fed and basically makes the no landing scenario, in their opinion, unsustainable. Now, it's all a matter of time in their view, they argue. They say market pricing of rate cuts by early next year would actually be wrong in a no landing scenario. The longer it takes to land, the longer rates are higher. So in other words, the longer we have this strong economy and strong reports, the more the Fed says, all right, I guess we don't have to cut anytime soon. Now, that is interesting because they do argue in this that services inflation has been sticky, but then in the same segment, they also say, quote, however, services have now started to weaken, and they use that to argue that GDP is slowing down. Well, that would then also imply that potentially core services inflation would go down, right? Well, yes. B of A probably didn't tie those two together, but this is the scenario that Bank of America says is not likely, but could potentially be seen as the best scenario because, again, it's better than the soft landing. The economy just keeps firing and inflation goes away slowly. Soft landing is the consensus estimate of Wall Street. And this is the idea that the soft landing is about 6 months away. Although, frankly, the soft landing has been deemed to be 6 months away for like the last 18 months. And the idea is that in a soft landing scenario, inflation comes down without needing to destroy the economy substantially and without needing to raise interest rates any further. Data so far has unfortunately, though, been consistent with a no landing scenario. That's not sustainable, not with a soft landing. In other words, we're getting stronger sales reports, stronger GDP reports, stronger labor reports than would be consistent with some form of soft landing. So this is your consensus estimate right now. Now, what's next? Well, now you get Bank of America's baseline estimate. And then we'll get into some of the worst scenarios as well. I just want to point out here, Joel just wrote a comment. I just bought my 5th course last night, renovation and property management. Love it. Had to pause to catch up on the live stream. Thanks, Kevin. Thanks, man, for saying that. That's awesome. Yeah, check it out. Meetkevin.com or click the link down below for those amazing programs on building your wealth. You can email us with questions at staff@meetkevin.com or bundle up at the website. Get some really great products. Still always trying to introduce new lectures and value for the existing members. We really love it. And it's free when we add extra content for everyone, of course. So what do we have with the hard landing, which is the Bank of America scenario? So with the Bank of America scenario, quote, we've consistently been expecting to take about 6 months to a year longer than the consensus for central banks to bring inflation down to target and start cutting rates. In other words, this is your over-tightened scenario where basically to get core inflation down, they need to keep rates higher for longer. And that ends up crushing employment, and you end up getting negative payroll reads, and you end up in a substantially worse economy than where we are now. In other words, they don't expect inflation to come down. It's going to keep being sticky, and that is going to force a hard landing style recession where you do get that unemployment rate popping up 1%. And then historically, once you pop up 1%, you're going to pop up another percent. So all of a sudden we go to 5.5% to 6% unemployment, which honestly is still not that bad compared to the 8, 9, 10, 11% unemployment we had during the Great Recession or during other recessions, not considering COVID. All right. Then you have hard landing scenario number 2. So hard landing scenario number 1 is just an unemployment recession. Hard landing number 2, which is scenario number 4 here, is something's going to break. That would not be great. There's an increasing risk that something may break. So far, nothing has broken. However, something can still break. As argued recently, the interest rate needs to be high enough to bring inflation to target. It's going to take longer. And in this higher for longer scenario, you end up getting something breaking. Wouldn't be great. This would be like more of a severe banking crisis, right? Number 5 is deemed to be the worst case scenario. The worst case scenario is stagflation. Not as likely as one may think, but it is a concern. It is likely at least for a few months once the economy starts to weaken. In other words, the economy weakens, but you still have high inflation. Now you're in stagflation. This is a less likely scenario, but it is still possible. Imagine a few months of rising unemployment or sticky, even rising inflation. It will take some time for a weakening labor market to actually bring inflation down. I put a little sad face here. This scenario is the most negative for risk and most positive for the US dollar. Central banks will have to stick with high rates despite a weakening economy. The longer this goes, the higher the risk something breaking and stagflation continuing as something breaks. Haha, typo. Anyway, then you have scenario number 6, which is a central bank blink. Okay, that is a little bit of a tongue twister. Central bank blinking. So the central bank blinking is basically delaying the landing of the economy, which ends up making the recession risks worse in the longer term per Bank of America. This is basically where you cut rates too early because you get spooked by something. And when you cut rates too early and you get spooked, you end up having the Fed temporarily call a victory. That is, they run a victory lap, but then you end up inducing inflation again, and you have to go right back to raising rates, which could lead to a worse hard landing. So these are the 6 scenarios that Bank of America believes are likely catalysts here. Specifically, their concern is that inflation will stay stickier for longer. And by staying stickier for longer, you're increasing the odds of a hard landing, which is their baseline forecast. The Goldilocks scenarios are really that you end up with either a soft landing or a no landing, which is basically the economy just keeps booming. Personally, again, I don't think today's employment report was great. I think, it was much better when we had job gains than losses. Well, we didn't have losses. We still had job gains, but I would have rather us beat on the number of people getting jobs and gotten a lower read on the wage gains. But instead, we got a higher read on the wage gains, a revision up on wage gains for the prior report, and a revision down on prior employment. And then obviously a miss on this employment. To me, that's not fantastic. That's the opposite of what you want. You want softer wage gains, still wage gains though. People can still earn more money, but softer levels with more people having jobs. So personally, I think we got the worst of both scenarios. But, we'll see. Some people didn't want a hot jobs report. Anyway, these are the 6 scenarios. Curious to know what you think, so make sure you leave me a comment to let me know which scenario you think that we are in at this time. All right, let's pop on over to CNBC for a moment.
Going to be this year is exactly what B of A says today. Hartnett says use Q3 tightening of financial conditions as an opportunity to position for a hard landing. And although June CPI will be the trough, there's a strong likelihood it goes back to, say, the 4s in the second half.
Yeah, which is exactly why I think you're not going to get a signal from the Fed or from the markets inferring the Fed's next move that says we don't have to worry entirely about that anymore. I still think it's an okay kind of mixture of factors that are driving things right now, which is relative to 6 months ago, the Fed is kind of moving in small steps with lots of time between each step. That's okay. The bond market is sort of stopped assuming we're going to get a rush to cutting rates, which means perhaps we're pushing off the recession risk. Earnings have flattened out. So all these things are kind of, in this more neutral zone as opposed to, at the precipice of falling away in a more damaging way.
But then, of course, as you look through the data, the average hourly earnings, those did surpass expectations, rose by 12 cents or 0.4%. That, of course, is what the Fed is paying attention to, because that is what keeps inflation stickier, regardless of, where the unemployment rate is. If people are getting paid more.
Yeah.
I mean, as long as it stays
they'll spend it.
Where it is,
I agree. Although it's funny, there's a lot of work right now talking about if that's really a causal driver of inflation or if it just kind of reflects the environment we've been in for a while. But, somebody could counter that and say, real disposable income is going to go positive again, or it's going to stay positive. And that's not a bad thing for the economy. So I think that's where we are. Yesterday, cyclical stocks took it on the chin with that yield move. Bank stocks suffered again. So it wasn't about, the big mega cap names that have performed so well that really took a gouge out of the market yesterday. It was the stuff that really is responsive to the cost of money, the trajectory of the economy.
Yeah, interesting note out of Fitch just now. Labor supply seems to have hit a ceiling as we didn't get any further improvement in labor force participation. They note that the unemployment rate did tick down a bit marginally. But to Mike's broader point about sort of macro uncertainty, that was one very large theme for Andy Jassy of Amazon yesterday, talking to our John Fort about how Europe may be doing a little bit better than they had priorly assumed, but certainly the overall macro picture globally is very uncertain. Here's what he said.
I don't think any of us believe we're out of the woods with the economy. As I said, I think there's a lot of uncertainty, and I don't think anybody knows what the next several months are going to be like. And, like everybody, we've got a plan. And, we had a plan the last few years, too, and things changed.
Pretty interesting series of questions about AI and chips and getting revved up to compete with NVIDIA, a consumer that's cautious. And also not just taking a look at costs in the media division, but across all their different silos.
Yeah, it was a really great interview that John Fort did there, talking about a whole host of issues. He asked him again, of course, whether he would be interested in spinning off AWS. He said they could be talking about that when they're 80, and the answer would still be likely the same. They have no plans to do something like that.
All right. Worth noting that Mercedes has officially joined the Tesla supercharging network. You are looking at Mercedes-Benz drivers gaining access to more than 12,000 Tesla superchargers beginning in 2024. And then following this, the Mercedes vehicles in North America will adopt the NACS charging standard in North America starting. That's the North American charging standard. So it's a little redundant. It's like saying ATM machine. But anyway, starting in 2025. It's also worth noting that you still have Volkswagen, BMW, Toyota, some of these other companies that really have to do a little bit of work with hopping on over to the Tesla charging standard. So we expect to see that soon. And although Toyota, not that many fully electric vehicles just yet. So, but we'll see. I think overall it's pretty good news for Tesla to see a Mercedes jumping over. Now you're getting some of the Germans moving over. Okay, that does it for our Meet Kevin report today. We will see you again in the future. I'm going to head over to the course member live stream now. We'll do some fundamental analysis together. I'll make another cup of coffee, so we'll be there maybe in about 10 minutes or so. And looking forward to chatting with y'all. We'll do Q&A, fundamental analysis. We could do some real estate analysis as well if somebody has a deal. And yeah, we'll chat. So we'll see you all.